we'll do a team question. Before we do that, we'll practice this a little bit. We might talk a little bit about the other exam question that is due on Wednesday, but before we do that, let's just make sure everybody knows what's expected on the second question. So I'm going to ask you about treasuries, and you're going to have how many bullets under that one? Two. All right. Before you say anything, write those 2 bullets down. Everybody just get a piece of paper out and write those 2 bullets down. I'm not going to give you a whole lot of time. Write them down. Writing is really, really important. Let's see. You have 2 things you're going to write under treasuries. And then we're going to do tips. How many things there? One item, pretty straightforward, although we know that the world's been a little bit different. One item there. And we're going to do MBS. How many items there? One. Just one. And you have corporate immunity. This is the one people lose the most points on. How many there? 3. And then one last one, high yield. How many things there? One. All right. So let's finish up that, and we'll go back to it. I can give you, go fast. Shouldn't take you more than 30 seconds, really. All right. So what's under treasury? Duration. So if rates are rising, do you want short-term or long-term treasuries? Short-term or rates are falling. Long-term. What's the second thing you do? Quality. If you're expecting a recession, are treasuries a good thing or a bad thing? Good thing. They're high quality. All right. Pretty straightforward. What about tips? Inflation. That one's hasn't been true recently, but I don't, I'm making it easy for you. We know tips have been more sensitive to real rates than they have been to inflations, but you don't need to get into that. But yeah, so if you're not expecting much inflation, you probably don't want tips.
You're sensitive to what type of rates?
Well, in reality, in 2022 they dropped because the real rate rose so much, even though inflation rose. So tips, they give you inflation, but they're also sensitive to the real interest rate, whereas treasuries, nominal treasuries, are sensitive to the nominal interest rate. What did the real rate do in 2022? It went from essentially negative 0.7 to positive 1.8. And so tips fell a bunch, but you don't need to do that on exam. If you're not expecting inflation, there's no reason to have tips. If you're expecting inflation, tips would probably be a good thing. MBS, what are we looking for there? Yeah, convexity or volatility. If you're expecting high volatility, do you want mortgage backs? No, you want them when rates are stable so you can pick up that higher rate. Our starting yield corporates. So look up at treasuries and do the exact same thing again. Duration, quality. That's exactly the same. If rates are rising, you want short-term corporates and munis. If rates are falling, you want longer-term. Very straightforward. If you're expecting recession, you want high-quality corporates and munis. If you're expecting a strong economy, you want lower quality to pick up the higher yield. And then what was the last thing? Tax. So then it's just a choice for munis and corporates there. So 3 bullets there. A lot of students only do 1 bullet there. And in high yield, one thing there, what's that? Quality. If you're expecting recession, you don't want high yield. In our dashboard meeting, we noticed this last week, treasuries, corporates, everything was down because of the inflation reports, except for high yield. High yield was not down that much. Why? Because high yield was much more focused on the economy and the stock market. High yield is really not that sensitive to interest rates the way other bonds are. All right. Then we get into the stock side. So you have large cap and who knows what else. So how many bullets here? There could be 3, but you're going to have, I'm going to give you 2. Bill Gates wants to keep changing my font for some reason. I don't know why he would think anyone would want that. I'll try to fix it. Then you have small cap or mid cap and something else. And how many things there? Again, you want 2 things there, although if you word the first one right, you may not have that. Developed markets, how many things there? Bill Gates, I don't know why he would think anyone would ever want anything he does with Word. Emerging, any things there? It's really just 1 from what I'm giving you. All right, so fill those in real quickly. So you have to ask, okay, they're large cap, well, what kind of large cap? Because large cap is one thing, but they have something else tied to them. They're small cap and mid cap, that's fine, but what kind of small cap or mid cap? So a large cap, what do you have? Well, let's start with the basic. Well, yeah, so you're talking about capitalization and quality. The exact same thing you need to talk about on small cap or mid cap. So you can cover it. If you're expecting recession within stocks, you'd rather have large cap instead of small cap. So you can essentially get credit for both by saying during recession, I would overweight large cap because large cap will do better than small cap in recession. Then you get it both places. All right. But you notice that phrase within stocks. If you have a recession, you don't want stocks, but to the extent that you have stocks, you're going to have more in large cap than in small cap. So that's where that within stock comes in. All right. What's the second one? Well, here it can be a couple of things, but again, it comes back to quality, but it could be beta or style. So if it's beta, do you expect a recession? What kind of stocks do you want? Low beta or defensive stocks. That's the same thing. Low beta is the same as defensive. A lot of students think low beta and defensive has something to do with value, but it doesn't. All right. Those are different things. So low beta defensive stocks, they do better in a weak economy. High beta growth stocks. I mean, see, I just messed up. High beta cyclical stocks do better in a strong economy. It's the exact same thing here. I don't give you anything different here. You just got to talk about it. But it will probably be different. If I gave you beta on large cap, I'll probably give you style on small cap. So which do you rather have on style in a strong economy? Probably value. The weaker companies, probably do better. Growth stocks you tend to like in a weaker economy. That hasn't been true here recently. Developed markets, quality as given, right? So if I say the US is having a recession, that doesn't tell you much. I gotta specifically tell you what's going on with those other markets. And what's the second thing? Currency. Yeah, if the dollar is weakening, that may be a great place. We're looking this morning. Japan is up so much more in the US market the last 12 months in yen. But when you convert it to US dollars, it's actually trailing the US because the US dollar is so strong. So if you had invested in Japan last year, you say, wow, I made a really good decision. But you would have been better off in the US because once you convert it back to US dollars, you're worse off. Right? In the emerging markets, quality as given again. You have to just see what we have there. All right, so we got 2 more to go. What's the one that we don't have up here yet? Yeah, stocks versus bonds. And that's entirely what? Quality. And then what's the last thing? Something on alternatives. Who knows what that might be? So their one is, you know, who knows? You just got to read and see. If I say commodity prices are falling, then what do you think about alternatives? You may not want to allocate to commodities if that's the case. If I say real estate's going to really take off, then that would be a good one to do. I don't know if y'all saw the news on commissions this last week. I actually think real estate commissions, some of y'all might not like this, but I think they're way too high and they're not competitive. I'm glad the courts have addressed that, but we'll see if it actually does anything. So I don't know if that adds up to 18 things, but it probably does. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, depending on alternatives. So, all right. So here's I don't remember what this question, what exam this, I must have written this in like the fall of 2023, maybe. So there's enough for everybody to get one. So just team members come down and grab a bunch for your team. All right, rather than grading team, I was looking through some of the answers. So let's just make it really clear. So remember what you're looking for. We talked about that last one. First of all, is this a strong economy or a weak economy? Is it a strong economy or a weak economy? It says soft landing, so it's weak but not disaster. Stock and bond interest rates will be volatile. That's kind of important. What's inflation going to do? That one's actually pretty accurate. The China comment wasn't very good, but bond spreads will widen. And they gave you right here, we should be more defensive. That's a gimme. If it's going to be more defensive, that always means you want higher quality. And then especially within our stock portfolio. So some concerns about real estate. So there's an alternative. The dollar is going to strengthen. That's an important one. Europe and Japan will see weaker growth than US. That's pretty important. Emerging countries might be the one bright spot, although that's definitely not true with China. That is probably the worst part of the whole forecast right there. And then the marginal tax rate is 30%. So
The effective tax rate.
you just ignore it and dark. When you're making a decision, you use marginal numbers. I just threw it in there. All right, so let's talk stocks versus bonds, which is not in there anywhere. So you want to overweight what? Bonds, especially high quality, and underweight stocks, given what? Weaker economy. So this is where some are going to lose. I was looking at one team going to lose a lot of points. We'll talk about more with treasuries, but you always got to say why. That's really, really, really critical. Long treasuries. So we said two things here. Overweight, given what? What are interest rates going to do? I didn't highlight that. Interest rates will fall. So I saw one team said overweight, longer duration. What's wrong with that? You got to say falling rates. You can't say we want overweight because we want longer duration, because why do you want longer duration? Because rates are falling. You see how picky I am? Why am I picky like that? Because in an interview, you got to make those points.
So within stocks, we go for the large cap.
Well, we're going to get to that. So this is the high level, which is usually the most important question. You're going to be overweight or underweight on stocks. Once you say overweight on stocks, and which ones? Underweight on stocks, which ones are going to be more underweight? But you're going to have the high level there. All right. So make sure you say it doesn't make sense. We're going to overweight treasuries because we want longer duration. That's like saying we want to overweight longer treasuries because we want to overweight longer treasuries. You're saying the same thing twice. Okay. Why do you want to overweight longer duration treasuries? Because rates are falling. Everybody hear that? All right. Team 6, y'all hear that? right? All right, y'all see what I'm saying? If y'all want your answer back, you can see. So I just want to make sure. And then you want to overweight given weaker economy. That's enough if you want to be more precise and like high quality treasuries, if you want to be more wordy, but it's the weak economy that makes you want to do treasuries. What about inflation? Underweight. Why? Given that inflation falling more than expected. I have some students to turn in the paper just as overweight, underweight, overweight, underweight. That gives you 0 points, even if every single thing you say is correct. Given the scenario, you have to say what the why is actually more important. So this isn't like a true false question exam where you can have a 50-50 shot. You have a 0% shot if you don't tell me the why. All right. So mortgage backs, what do we want to do? Underweight given high volatility rates. You don't have to say interest rates. I know you mean that, but high volatility rates. I don't know why I can't spell volatility. I don't know what this over here is. Okay, Bill Gates is trying to help me. Not really helping. All right, so not much more you have to say there. Now, someone was asking, well, don't treasuries have positive convexity? You can certainly talk about that here if you want to. Really, mortgage backs, they're high quality bonds. If you remember, high quality bonds, Ginnie Mae itself is full faith and credit. So you're really choosing between the high quality of the treasuries and the high quality of the mortgage backs. Treasuries, especially long treasuries, have positive convexity. Even short-term have positive, not as much. And mortgage back have negatives. So it's a quality versus quality. Why would you do the mortgage backs? Well, if interest rates are going to be stable, you're getting that higher yield and you're going to get the capture of that. So you're essentially covering treasuries positive convexity when you talk about mortgage backs. All right. So here they're medium quality. So underweight as prefer higher quality. What am I missing? What word didn't I say yet? Given weak economy. Underweight. That's prefer longer term. Am I missing anything? Given what? Falling rates. Within or muni prefer which? Did y'all do the math?
Yes.
Given lower tax adjusted, munis. So you did what? 0.037 divided by 1 minus 0.3. What was that number? 5.28 is lower in court, 5.5%. Now, some students take the 5.5 and divide by 1 minus 0.3. That makes no sense at all. Corporates are taxable. There's no reason to tax adjust those. Okay, high yield. I'll have at least 5 students. We'll say avoid high yield because rates are falling or over allocate. What do you say about interest rates with high yield? Nothing. They don't really care that much.
What is that funding for? And what is she giving 20% for?
This is the yield for munis, 3.7 to 0.3 is the marginal tax rate. Remember the tax adjusted yield formula. You're going to put it in question 1 as well. High yield, what do you want to do here? Underweight. Someone complete the sentence. Given what? Weak economy. Yeah, that one's. Economy's not doing well. High yield are not going to do well. That's, I think, a given. And y'all think of a scenario where U.S. economy was doing badly and high yield had a great year? I don't think that's ever existed.
For the corporate meeting, are we gonna like do the math like from our head, or do we use like a?
Yeah, you have a calculator. Yeah,
Okay.
yeah, that's the only math on the first exam. All right, large cap, underweight or overweight. And what words do you want to start this with? Within stocks. Overweight, large cap, given what? Weak economy. Within stocks. Overweight, low beta, given weak economy. Small cap,
Would you say beta was the same? You said beta was the
beta is also defensive.
Okay.
Small cap, underweight. Small cap, given the economy. Underweight what? Value stocks, given the economy. Remember, value stocks are low quality companies. They're not going to do well in it. So a lot of students lose a lot of points here. If you said on this one, within stocks, overweight, large cap, given weak economy, as preferred large cap over small cap and weak economy, you would have gotten points in both places. You notice I repeat here, large cap, low beta. A lot of students will say underweight, given weak economy. Well, is that because they're large cap or because they're low beta? The answer is yes, it's both of those things. But what if I given you large cap, high beta stocks? Then you got a problem. Well, the large cap I like, but the high beta I don't. It's two different things, all right? So if you say this, you'll get one of the 2 points. Because I don't know which of those you're wanting me to find. It's both of them. There's 2 things there. All right? Same thing on small cap. Underweight, small cap. So you see how I'm repeating myself. Underweight, small cap. You can use abbreviations like that if you want to. All right, developed markets. Underweight, given weaker growth in US. And what's the other one? Underweight, given strong dollar. If you want to say US dollar, I realize the US isn't the only place that uses the word dollar, so dollar will strengthen. Emerging. Overweight, given stronger. You want to be real precise, relatively stronger economic growth. You want to say especially China, although that one was really wrong in this particular scenario. Everybody was thinking, I mean, that was a thought back when I wrote this question, is China's coming out of COVID lockdown, boy, their economy is going to take off. And they didn't do that at all because of the real estate problems and other things. In alternatives, here you got to be a little more precise. You can't just say overweight or underweight. You have to say which one. So what do we know about this? Yeah, concern about real estate, has some overbuilding, remains relatively elevated. So underweight real estate, given overbuilding or whatever you want to say. You just kind of summarize what they're doing. Is there anything else you can say here?
I mean, there we go.
Yeah, underweight gold. Given what? Strong US dollar and falling inflation. So that gives you the two there, huh?
For example, what would be the opposite of that? So like, let's say like the gold goes up. I mean,
Well, the
gold
gold
goes up.
gold has historically been a hedge against inflation, but we know the last several years, it's all been about the US dollar. Gold has been really sensitive to the US dollar. So a strong dollar, gold has done badly. That's why in 2022, gold didn't do well. We had all this inflation, but what happened in 2022? The US dollar got up.
If the US dollar goes up, what commodity would you want to invest?
Oh, I don't know. There is a commodity. Oil is highly correlated to the US dollar. And it's actually interesting looking at oil and gold. I'm not going to throw something that if I think oil prices are going up, I'm going to tell you in the question. It's really hard outside of gold to make a strong statement about a commodity and U.S. currencies. Oil is interesting because a lot of oil is priced in dollars, so it tends to have a strong relationship. It is interesting historically, go back and actually graph gold prices versus oil prices, and you'll see some really interesting periods. They tend to move somewhat together, but when they separate, there's usually an opportunity there to do something interesting. All right, so how many things do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. Does that number sound familiar? Got our 18 items. What questions do y'all have? This is happening on Wednesday, right? Uh-huh.
So then would it be wrong if I did mention oil, like if the US dollar is strong, is it that we had a cheaper?
What I do down here, I don't get extra credit, but if someone forgot to talk about real estate, but they brought something up and they made a logic argument, I might, instead of giving a full point, maybe get 0.8 because you forgot to mention real estate. But the alternatives is really knowing what is an alternative. So if I mention private equity or if I mention commodity prices, that goes under alternatives. And then gold is kind of the go-to on the dollar and inflation. So you might know to put something there.
Alternatives will be anything that's like not commodities, stocks or bonds.
What would be?
I'd say alternative would be anything that's not stocks, bonds, or commodities.
No, commodity is all alternative. Commodities, remember real assets, so that's real estate, timber, and commodities. And then we put venture capital in there. Those are the only ones I gave you. I didn't give you infrastructure. I mean, there's a lot of others that are real assets like infrastructure or oil paintings.
Whatever it says, soft landing, it's going to be like deep economy.
Well, soft landing was a tough one here, but they gave it away. How did I give it away here? We should be more defensive. All right, let's see what spammers calling me here. So they gave it to you there. You could have had the big debate. Well, soft landing, that's kind of what the market was hoping for. Markets might, yeah, you could have a lot of, but she gave it away when she said we should be more defensive. That's a pretty strong statement.
So let's say you were funding it for the remainder of 2023 because it said that it was going to be low for most 2024. Like if it was hadn't had that, but you just said that there's going to be a soft landing for 2024. Wouldn't that be good? Like maybe there's a positive outlook for the economy in the future.
Well, I would go with the obvious. So if she says something like, boy, things are going to blow up the next 6 months, but the Fed's finally going to be successful, or whatever. Well, that sounds great for 2025. If I were that, it's like, okay, for the next 6 months, boy, I'm going to be pretty defensive, but we need to be ready to move the setup for 2025. So yeah, those are things you can say. It's hard to work it in this particular format, but yeah, those are kind of things you can think. So there's a timing aspect to this. If you think things are going to fall apart, that doesn't mean you wait until the very end because markets don't react once things recover. They react before things recover. So you got to be a little careful in timing.
And going back to the defensive thing, what would like the opposite example for would you say like if you more aggressive, with oil or this?
Yeah, so it depends on what interest rates did, but you don't want treasuries.
So like in the example that it was giving us, like you said, we should be more defensive in our portfolio. What would be the opposite of that? Would they say we should take more risk?
Well, we can be more aggressive. We can take more risks. There's a lot. I mean, I could have said this differently as well, but yeah, it's you kind of read between the lines of what they're saying, and here it's not really enough between the lines. Yeah, part of this is just, as a finance major, hearing what they're saying and being able to reinterpret it into asset classes. Okay?
On the part where it says summa writing the tax rate, or in the state, our tax rate. How do we decipher that? Like, what do we do with that information? How is it useful?
Here,
Uh,
well, you only need one number. And the formula is tax exempt yield divided by 1 minus the marginal tax rate. That number, you compare it to the corporate yield. If it's higher, munis are good. If it's lower, you want corporates. So it's in the class notes too. It's a pretty straightforward formula. You don't do anything different.
What do you call it?
The tax adjusted yield. Other questions?
Underweight or corporate, like overweight corporate relative to that means.
Yeah, so here's one of those within kind of questions. So we're underweighting both of them, but we're not going to go to zeros. So within what's remaining, our preference is toward corporate. It's a lot like stocks, right? We're going to underweight stocks, but hey, we're not going to go any zeros. So within stocks, we're going to overweight large cap and underweight small cap, or overweight defensive, underweight value. I mean, yeah. Yeah, so that's why that word within makes, now if you're overweighting, you don't need to say within because everything's just higher. But it's when you're cutting back, you say, we're cutting back on stocks, but within that group, that we're going to cut back more on small cap than on large cap.
Do you know, for example, of like any, like Spotify or like any podcast where they're like talking about these forecasts? So we can like listen to them and know.
Not in the exact same format because everybody does it differently. I don't think there's two people that do it the same. Yeah, USA, we wrote it every week. It just depended on what was going on to your terminology. These are a little bit similar just because I got to write an exam every semester, so I tend to use similar format.
So often every week.
Well, our focus is more on what we do in the dashboard team is to talk about what just happened.
Okay.
If it's hard to do every week where you're talking about a forecast because you're probably not going to change. You're not changing your view very much. So usually this is exactly what we're doing on dashboards. What's the long-term trend? Do we see anything that's indicating maybe there's a change going on? So if that's the case, then you want to start warning people about it. Otherwise, it gets repetitive. We continue to believe, we continue to see this as a good place to be. It's kind of like GMO. GMO is where I am, small cap value. I still think that it's been wrong another 2 weeks in a row, but yeah, it's just not coming around.
Just thinking a little bit forward. So like for those of us that are going to graduate or like over the summer when we don't have access to like the Bloomberg terminal or trying the dashboard, how can we kind of gather that information so we can still do this?
Well, you can see a lot of the information you get from Yahoo Finance. So you could set up your dashboard in Yahoo Finance. There's a way to use Python to actually bring that data in if you wanted to. I haven't, we had a program in Python some semesters back, but I haven't looked at it. Yeah, if you don't, then you'd have to collect the data yourself. That's why I'm doing the dashboard team, is to show you the key things I would look at. Bloomberg's nice because then we can go around the entire world. We just saw Peru's was up, what, 9%. Why is that? That's kind of strange in a week. We saw, what was it, Argentina. So we're seeing some countries that have really done horribly and they're suddenly coming back. Is that I might have talked about this before. In USA, we call it, for some reason, a dead cat bounce. I don't think dead cats bounce, but that's what we call it. What's a dead cat bounce? It's something that's been selling off and it just has a momentary up and then it's just gonna keep going down. It's dead, but it hit the ground and bounced. But I don't know if he threw a cat off a 10-story building. I don't know if it would bounce all that much. But that's what we call a dead cat bounce. So is Peru a dead cat bounce? Or was it a true coming back? So that's kind of what you're looking for. So for me, what am I looking for with small cap value is, man, they're just so cheap. But small cap is so wanting the Fed to cut rates. So the Fed does start cutting rates. That's probably when my story is going to look really, really strong. But right now with these inflation numbers, people are like, oh, it's still not happening. So I'm having to wait out. Will the Fed eventually cut rates? Yeah. For small cap value is going to take off. Yeah. So I just got to wait that out. But right now everybody's like, no, it's going to take another 2 or 3 months. So you have that in your mind. Now, if the Fed starts cutting rates and small cap keeps underperforming, then I'm in a lot of trouble because my whole thesis is broken. Other questions?
This is back to your point about saying you can do a dashboard to get off the content. Is it like the Python library or do you have to create it?
There's Python programs already out there. If you know Python at all, you can easily find one that's great from Yahoo Finance specifically. And then you just find one program and all you got to do is change the ticker to whatever you want. We did that in the Investment Society. I don't know if I have one of those saved. I'm sure if you YouTubed it, writing a Python program to scrape from Yahoo Finance, I'm sure you'd find all kinds of stuff.
It just creates it, right? Just type it.
Well, there's programs already written, and they're probably written for the S&P 500, but you can easily change it to small cap and the other ones. You just get the ticker. Yeah, I mean, I'm discovering most people don't write Python programs. Most people copy Python programs and edit them slightly because someone else has already done all the work. So yeah, it's not, you'd have to have all the Python stuff set up on your machine. I'm going to talk a little bit more about that at Wednesday's Investment Society meeting. Anything else on this? We put a lot of time and effort into this. So hopefully Wednesday y'all do well. But it's not just Wednesday. This is the kind of stuff they're expecting you to be able to handle in an interview that most finance students can't. So I'm trying to get you out there so you start thinking in these terms, because this is not very textbooky, is it? You're looking at a textbook that's like 10 years old and it's like, it just seems completely out of date, but this is the way, and they expect you to know this because they do it every single day. They don't realize that undergraduate students are kind of in a vacuum outside of what the real world is. They're expecting you to do this. So you guys somehow have to get yourself into that mix. All right, let me real quickly, I'm not going to show you this much, but I'm going to show you a question 1 answer from last semester. So she defined investment portfolio, asked the question, why are you investing? She highlighted the word horizon, which makes sense. She put it into your own words. So you got to make sure you put it in your own words. No, I wouldn't do any copying and pasting. You already should have this written. So if you haven't started yet, you're in a lot of trouble. This is not something you can write in 2 days. She talked about the what with the parsimonious and the style. On style, you might say, okay, style, how important is style? Well, there's a former student of mine that's looking at replacing their advisor. And none of their advisors will give her historical performance, which is typical for advisors because they're not CFA firms. So essentially, the committee's being asked to hire someone without any evidence that they're any good. Doesn't make sense. Except for one firm was a CFA firm, they provided historical performance. But then we have to ask, so make sure you're mute. So then you have to ask which of those portfolios they provided actually fit what they're doing. They didn't tell us what those portfolios were. They just gave us a bunch of their portfolios. I took all of those, put it into a style model, and I found the one that was closest to their strategy. Then I compared it to a Vanguard index fund to see are actually providing a higher return than their fees. So I did the style analysis, and it took me like 3 minutes to do it. I just plugged it in the spreadsheet, calc. So that style analysis is actually quite useful. Then how will you invest? The passive, the strategic, and then the major asset classes. She talked about cash versus bonds. Then she talked about cash and fixed income. DC cuts high. Duration. What's she going to do on duration? Define subcategory strategy. Define subcategory strategy. Just do that over and over again.
When we go over the strategy, should we give
Yeah, if I expect rates to rise, I want to shorten duration. It doesn't have to be a massive undertaking, but yeah. So she does the DC cut size. She does put some formulas in there on duration, minus duration times the change in yield. Convexity, I don't know if she put that formula in there. You could. You do need on convexity to give me some explanation of what is convexity all about. It's about these optionality bonds. That's the key to them. Mortgage backs, they have this option they give to the borrower, which is huge. Talked about credit, currency, tax. So you put the tax formula in there. Structure, look at structure is not a massive undertaking. Inflation, not massive. Then stocks, a lot of students lose points on stocks because they don't get the introduction on stocks. You got to talk about the expected return on stocks. Then she talked about beta. Again, beta, define subcategory strategies. Same thing all over again. Then she talked about capitalization, style, US versus non-US. Then alternatives, real assets, venture capital. She put some extra stuff in there that you don't really need. But there's her answer. It looks a lot like pages 3 through 18 in the class notes, doesn't it? So you should already have your answer done. You should already have it drafted. It's just now a matter of perfecting it. All right. Y'all want me to put this out there? I've never had no as an answer to that question. All right. Let's do a little bit on return. What we're going to do on today's, I'm going to do a little bit on return. We'll do more on Wednesday, but also on Wednesday, I want to talk about paper 2 because I should have a file hoping this weekend for you to do paper 2. Paper 2, you don't have as much time, but it's a much faster paper. I'll create an Excel file that has the stocks you can choose from. I have some great alternatives. I just saw the Dollar Tree had a big report. Oracle had a big report. So I've got some pretty good stocks to do paper 2 for. So I'll hopefully have that file this weekend. So
Do you have some strategies that we should have in the contract or?
well, you have to say what you mean by the strategy. An example is if I expect rates to be volatile, I want to avoid mortgage backs. All right, so on return, there's 2 things you got to do on return. First is getting the holding period return, and number 2 is linking. You're going to do both of those in the second exam. This will actually probably be our next team question. The holding period is you want to return for some short period of time just to know how they did. Usually that's monthly. So how did you do this month? Once you do this month, you then have the previous 36, 40 months, whatever. So like with the person I was helping this last week, this particular person provided their firm's returns monthly. It's almost always monthly for the last 10 years. And I could take that and put it into a file with had all the asset classes and see what asset classes were they actually exposed to. That's the holding period return. We're going to talk about the formula for holding period return. We're going to use a very simple approach. That's not the allowed approach. So we'll talk about the allowed approach, which is the modified D. So we'll get into those. But that's just to get you one period return. So UTSA, we did weekly for stocks or even daily for stocks, and we did monthly for bonds. Monthly is the most common. Now, this firm I was helping, they get returns from their provider, but they don't do it for a month. They do it like from January 23rd through March 22nd or something. It's just bizarre. Why did they do that? Because that way they figure you can't figure out if you're doing a good job or not, which is their whole goal. It was really, really bizarre. But most people do a monthly. So how do you get a monthly return? You look at the price change. What was your market value at the end of the month versus the beginning of the month? What is the beginning month? What is the day that begins the month for March? And don't say March 1st. What would it be? What's the beginning market value for March? February 29th. All right. Your beginning value is the ending value of the previous month. Okay. So the beginning market value for March is the ending market value is March 31st. Beginning market value is February 29th. Okay. And then accrued income, we're going to keep it really simple on accrued income. We're only going to do stocks, so that's just going to be dividends. You just got to figure out which dividend is it. Is it announcement date, X date, or payment date? We'll have to get into that. And then again, beginning market value, the same beginning market value. Modified dates is the same thing except for we adjust for the timing of the cash flow. So if you didn't make any investments during the month, it doesn't really matter. But if you invested 20 million on March 20th, we got to somehow adjust for that. This simplified approach doesn't do that, right? In fact, it really gets messed up because you invested 20 million, your market value is $20 million higher, but that's not part of your return, is it? You put 20 million and you can't say, wow, I'm up $20 million. Well, yeah, you put 20 million in. So this approach assumes there was no cash flows during the month. Modified dates adjust that in a very complicated way. I'll show you their formula. All right, so the accrued income for stocks, and I'll just tell you now, it's X date is the key. You'll see that X date. It's not announcement date. It's not payment date. It's X date. That's the day where if you own the stock on X date, you're getting the dividend even if you sell the stock tomorrow. All right, so if it X dates today and you sell the stock tomorrow and it doesn't pay for another 3 months, you're still going to get that dividend. So X date's the key. That's when the market reflects that dividend. For bonds, it's much more complicated. On bonds, you have to actually do that thing you did in accounting, which is accrue the bond income for how many days it is versus we're not doing any of that. All right, I'll let you do that in your accounting class. So we're only doing stocks, and stocks is real easy. If it's the month of X date, you put the dividend in there. If it's not the month of X date, you don't include the dividend. Real simple. I'll give you the announcement date, X date, and payment date. The only month you care about is the X date. All right. So we're going to work some examples. I'll do them in class. The second thing you got to do is once you have a monthly return, you now have a bunch of monthly returns. We now have to link them so we can see how people did over time. We want to know what is their return on average the last 3 years? What was their standard deviation the last 3 years? So the holding period just gives you one period. Once you get one period, you then combine that with a bunch of previous periods, and now you can measure return, you can measure risk. You can do things like beta, standard deviation, alpha, all those kind of things. So we'll get into those. So, all right, so we'll stop it there. I'll give you an extra 5 minutes to prepare for the exam. So the question is, what would you have answered 3 months ago versus what you answered today, and how different is that? If it's the same answer, then we've wasted 2 months of your life. If it's how many of y'all would have a different answer today? Is that most of you who wouldn't have a different answer? So it should start getting, I mean, this is about as basic finance as you can get. This is what people expect you to be able to talk about: rates, economies, all that kind of stuff. So it's really, really critical stuff. All right, let's talk about paper 2. So paper 2 is the easiest of the 4. You've got about a month or 3 weeks to work on it. It says select a company. I've got a list of companies for you to pick from. We'll talk about those, and we can add more if we need to. Earnings in March, I'm essentially cutting it off now, but if we see others coming in, we can consider them. I usually use NASDAQ, their earnings calendar. The reason I like NASDAQ is that they put the market cap in there, which I like a lot. I like to know how big the company is. So today, nothing, well, that's some of these are not really companies you'd want, but Micron could be interesting. They've been up a bunch because of the AI and all of that. So we'll see. Their forecast is to lose money. General Mills could be interesting today. So we'll see. There are some. You notice they haven't released yet. Why? Because most firms release after close. Well, the market is closed. So most of these firms may have just released just right now. So they usually release right after close. So we'll see. But we'll talk about the companies. I'll put on the list and we can add more. So you're going to do very similar to paper 1. Say, what did they report versus what was expected? I'm giving you the expected from Bloomberg. If you read articles, it's possible you have different expected numbers because there's several sources. So I'd recommend you go with what's on the Bloomberg because it's a recognized source, but it may have a contradiction with some of your articles. They're not always unusual items. I'll show you some examples. There's a couple of companies and examples I gave you where there's some, like the reported is negative $2, but they're adjusted as positive $2. And there's a massive difference in those. And anytime you see that, you have to say something about it. You know, if they reported the big loss, but they're saying, hey, we've got this one-time thing we got to pull out. You got to talk about that. And then you're going to look at not last quarter, but the same quarter prior year because of seasonality, especially retail stocks. So you want to look at how did it do last quarter, last year, the same quarter. So all of that I have built in what I'm going to show you. So you look at earnings per share. That's the key, earnings per share. And then most articles, 90% of articles are going to have earnings per share and revenue in the primary paragraph. Did they beat on earnings? Did they beat on revenue? Are they higher than last year? Or are they lower than last year? Those are the two you're going to have. You do want to talk some about margin. I'm giving you gross margin and net margin. I'm actually giving you EBITDA margin. So gross or net. Gross is, you know, revenue minus cost of goods sold. That's been a big deal. I can't remember. I gave you a couple of retailers. So firms like Kellogg's or General Mills, inflation has been a big deal and it's been eating into their margins. So gross margins actually been pretty material here. And then net margins, which is your gross margins minus all your other expenses. I've given you both of those, but I gave you EBITDA margin. And then you're going to start trying to explain what's going on with the numbers. What did management say? I'll give you some examples there. Look for articles. One really, really good source is get on the Bloomberg machine. They have two functions. The news function, if you type NEWS and type in search on your company name, you might see a good interview about your firm's earnings. Or do AV. This is I forget what it stands for, but it's their videos. And look for your company on that date and see if they were talking about them. You can get some really good documents. The AV might even be better because they don't always write articles on these firms, but they usually do have some kind of interview where we'll talk about the firm. But look for articles, those kind of things. And then the market's reaction. Some students get confused. By market's reaction, I mean the market reactions to the company you're writing about. So some students like, well, the S&P was up 1%. Well, you know, you got one company out of thousands. You know, how did the market react to your companies? So I'll give you some charts on that. And then just your conclusion, did the market react correctly or incorrectly? What does it see? Don't talk about valuation. I have some students that say, I think this is a good buy, or I think this stock you should avoid it. That's paper 3 and 4. You can't decide whether a stock is a good buy or buy bad just based on its earnings release. You got to do evaluation and all that. So you're really just looking at the reaction. Where can you get some good information? Well, one of the firms I'm giving you is Adobe. I went to Adobe's investor relations and look at what they have. They have the earnings release, press release. And then look at this. It's pretty incredible. They have slides, charts where they talk about what's going on. So this is essentially their earnings call, summarized, all fancy. So you could certainly do that. I don't know how many of y'all have listened to an earnings call. I'd recommend you do at least one before you interview, just so you can say you did. And they're usually out there. The transcripts, Bloomberg has a transcript, but they're computer generated transcripts. So there's a lot of typos. And there's some typos that are so bad, you're not even sure what they're saying because it's just so bad because they talk kind of like I do, too fast and kind of mumble. So if you can get the actual call itself and listen to it, I'll warn you, they can be incredibly boring. So you have to be, I mean, it's gonna be an hour where the first part is just really, really boring. Unless Elon Musk is on the call, then it gets really pretty exciting. But what you're really interested in is the end of the call when the sell side analyst, y'all know sell side and buy side, right? The sell side analysts, they work for investment bankers. They don't buy the stocks, they just give commentary about the companies, and the buy side is the ones actually buying the stock. The only ones allowed on the call are the sell side. The buy side can't come in on these calls. So this is the sell side analysts. They know these companies better than anybody. So they're going to ask the most astute questions. So if they ask a question, it's probably something you should be worried about. So that's why I love to go to the end and look at what is the sell side asking. The first part is a kind of management putting a spin, positive spin on everything. And what you all hear sometimes is pretty amazing to me is a firm had just horrible numbers. And the CFO is like real calmly talking about really unimportant stuff. And you're like, why are they talking about that? That wasn't important. And so, but then you get to the questions. Now they're very polite on the questions on the sell side. The last thing you want on the sell side is get management mad at you. So they're going to be, very professional. They may ask a really tough question, but they'll ask it in the nicest way they can because they don't want any bad marks against them. So these are all good things to look at. A lot of stuff, right? So the firm itself, now realize if the firm's your source, that's a pretty biased source. Be careful with that. But you do want to look and see what they're saying. What are they focused? You really is the key is what are they focused on? So undergraduate students make the big mistake of focusing on the 30 most important things. That's not how it works in finance. It's the 2 or 3 most important things. All right. Finance students, it's like, how many more pages can I add to this paper? No, that's your goal is not what are those minuscule things? What's the most critical thing? Sometimes it's only one thing that's so important to them. So what is that? You want to focus in on that. You want to figure out what that is and really write about it. We've had students compete in the CFA Research Challenge. We've done really well. 2 teams ago, we actually won the Southwest, which is pretty impressive. We beat UTSA and Rice and all these other schools. That team, their focus was to really figure out what was the key issue, and they came up with this one key issue, and the judges loved it. The Rice team that was in second place, they were up against each other at the very end. They just had too many issues, and it just got garbled. So that's really what you're looking for. What is that one most critical thing that you want to write about? And that should be a question that the sell side analyst will ask. But you can see it goes on forever. Now, you may find some really good charts in here that you might want to bring in. Most firms do have all firms have an investor relations. Not all of them share information as well as others. So firms like Google or Alphabet may not share as much as another firm might. So you're just looking for any key you can get to help explain what's going on. So that's the paper. It's pretty straightforward. So here's the companies I brought in. I got them all linked over here. So Adobe, Anheuser-Busch, AutoZone. I got another alcohol company, not them focused on that. They just reported Costco, Dell Computer, which has been a really interesting firm. That's a firm that was private and they were public, went private and came back public. So they're pretty interesting. A few retailers, GitLab was interesting. A few more retailers, quite a few retailers. Oracle had a great report. Nordstrom's had a terrible report. Target had a great report. Costco had a bad report. Thor had a horrible report. You may know who Thor is. You probably don't buy their products. They make I can't think of it. I mean, say Winnebagos. They don't make Winnebagos, but Winnebagos, the big campers and what's the word for it? I can't think of the word. But yeah, like a big bus for camping. That's what Thor does. Another retailer, Zoom came out. So if we look at Adobe, this is what I give you. So I give you this quarter and the prior quarter. I give you the inside quarters as well. So there's reported, there's comp, and there's estimate. Reported is the actual GAAP number that they reported. The comp means comparable. That's the number the market's focused in on. All right. They're not focused on the reported, they're focused on the comparable. So the earnings estimate is against the comparable. This 2% surprise is off of the comparable, not off of the reporting.
Do you mind speaking more about what's comparable?
Well, what they're doing is they're saying there's some things in this number that are one time, don't want to ever repeat. Our true earnings were $4.48. We're reporting $3.34 because we have to report according to GAAP, but our real earnings are $4.48. You might have heard this term as adjusted gap. I don't know if you've ever heard that. So as reported, the reported numbers are the actual gap numbers. But the adjusted gap takes out any unusual items.
And so, as we're writing the paper, or even if we're looking at different companies, which number should we?
Yeah, if you see articles, they're gonna, what you'll normally see is something like this. Adobe reported earnings of 4.48. Parentheses 3.345 before adjustment for whatever. And that 334, that's the only time it's talked about. Everybody's focused on the 448. But you do want, that's why I say any adjustments. That's a pretty big adjustment, right? That's like a 25% adjust, 30% adjustment. You probably want to say what that adjustment is. You know that the Adobe is consistently that adjustment. So it might be the same thing over and over and over again. For some reason, the market says, hey, gap reporting, we don't care for that. Take that out. And so people gotten used to it until you just know this estimate is based on however they're doing their accounting here. All right. Most articles will tell you that if it's material, if it's not material, let's see if we can find one where it's not material. So here, look at AutoZone. They're exactly the same. There is, so you wouldn't even talk about the adjusted there, all right? And there's some, there was one that was pretty crazy. You notice most of them are really, really close. Look at this one, Foot Locker. Any noticeable difference there? Do you think you could have this company and not talk about that difference? That would just, there's no way, you'd have to mention it. What is that difference? That's pretty, I've seen Best Buy had a quarter like that once, -4 versus +4. You're gonna have to say something about it. What's the chances the article won't mention that? Probably not much at all. They're gonna have to mention that. That's pretty radical. Wouldn't you wanna know if you have this in your portfolio, like what in the world? You know, you see that reported earnings like, man, are they going out of business? What's going on? Oh, there was some one-time adjustment. All right, so you're gonna talk about how they did versus expected. They were expecting 4.378. They got 448, so they beat by 2%. They were 18% above same quarter last year. All right, you see that? Everybody see those are the two numbers you're going to talk about. Now, when do you use so here you're going to use the word beat or miss. Here you're going to talk about higher or lower. All right. So they beat estimated earnings by 2.33%, and they were 18% above last year. I've had students say they beat last year by 18%. You can say that, but it's just weird. That's weird sounding. And again, you don't want to sound weird in interviews. So we don't talk about beating last quarter. You talk about beating the estimate and you're higher than last quarter. All right. Just so you kind of get the nomenclature. Everybody understand that? So beat or miss. Find one. So how would you say Dollar Tree? They missed estimates by 3.95%, but they were a full 25% above last year. All right. So that's on earnings. The second part is revenue. It's the exact same thing. They beat by 0.76% on revenue, and they were 11% higher than last year. All right. Gross margins. All right, so here gross margins are percents. Neither of these were percents, these were dollars. How do we compare when we're talking about percents? Remember on the treasury, we didn't say 2%, 3%. What did we say? Basis points. Guess what we're going to do on margin? Basis points. And guess what favor your professor did for you? I put it in there for you. All right. So the market was expecting 89%. they got 90%, so they beat by 63 basis points. And they were 42 basis points above last year. All right. And then EBITDA, that's $1, so they beat on EBITDA, but the EBITDA margin, that's a percent we talk about beating or missing by basis points. All right, everybody clear on that? And you'll probably see that in the articles. You can say their gross margins were 40 basis points above last year. They use basis points because it gets really confusing to talk about the percentage of a percentage. Okay. Now, Adobe looks great, doesn't it? They beat on everything. And they're higher than, so how did their stock do? Anybody want to guess? What was the surprising reaction of the market? Yeah, they were down 13%. How can you beat on everything and be down 13%? Well, that's a pretty exciting paper to talk about, isn't it? That's kind of like the one you want. That's the great one. That happens about 40% of the time. Where a firm will meet or miss or beat, and the stock market will the opposite direction. This is pretty radical when they beat on everything and the stock market really sold off. So obviously something else came up that's driving the stock. It might be management said something about the current quarter or the next quarter, or something's going on that the markets just said, hey, we weren't expecting that. Yeah, we got good numbers this quarter, but wow, you're already way behind this current quarter, or something's going on. Now on this bottom part down here, I'll give you a chart that shows you kind of intraday. You can probably create better charts than this. The chart I use in Bloomberg is called GIP. The GIP function allows you to compare. You just got to make sure you have the right day. That's where it gets really, really tricky. So what is the correct day? So this is Adobe. And they said they announced on 3/14, but when did they announce? Before open or after open? That makes a big, big, big difference. So if we go out to Yahoo Finance, and we look up Adobe, and we do historical, how can you tell there's a really clear sign which day you're interested in? What do you think that is? What stands out on that chart?
14.
But what stands out? What's the one column you're looking at? What column are you looking at? Volume. When do you think the volume's the highest? So when did they report? Before open or after open? I mean, after close. After close on the 14th. How do you know it's after close on the 14th and not before open on the 14th? If they had reported before market opened on the 14th, the volume would have been high on the 14th. All right, that's how you can tell which day you're. So which day are we interested in? We're interested in the 15th. Because you didn't know their earnings on the 14th. They didn't announce it until after the market closed on the 14th. So you see how volume helps you know which day you need to be looking at. There's a few stocks I looked at, it was really, really confusing to me because the market started reacting before they release. But volume will tell you. I mean, it's pretty obvious, isn't it? It really, really should stand out. Let's look at Foot Locker, see if that tells us the same thing. Any day stand out? The 6th, yeah. So that helps you a lot if you're ever not sure, and it can be really confusing. So the 6th, when did the volume hit? On the 6th, so they probably reported before open on the 6th. All right, because if they reported after close on the 6th, you would not see the volume on the 6th. All right, so that helps you tremendously on that. It's really frustrating, like in the NASDAQ earnings report. I wish they would say whether it's before open or after close. I wish they would say that, but they don't say that in there. There is one time, I think it was Alphabet, accidentally reported before close. And it just, the market went crazy. You weren't, no one's like, wait, why did they do that? They're supposed to wait 5. Someone just hit the button a few minutes early, just freaked everybody out.
In that case,
Yes. Is there any repercussions for
the person.
Oh, it caused, I don't know if anyone got fired or anything. It wasn't like illegal or anything, but it was just like people were just like freaking out. Like, you're not supposed to do that because they're all shut down. The trade rooms shut down. It's like, we can't trade today. They're reporting after close. And then suddenly they report at like 2:55. And everybody's, what do? You got to go, our traders go home like at 11 o'clock. right? And so suddenly they have that. So yeah, it was really frustrating. So that's the biggest sign. I won't say it works 100% of the time because some firms, the market starts getting excited. There's like whispers things going on, but that's usually, I mean, it's pretty obvious in some cases. Right? So I've given you a lot of the data here. Now let's look at returns. And you notice on returns, I have Adobe. I do have the S&P 500 as well. So let's say Adobe's down 13%, but the S&P was down 24%. Well, maybe Adobe didn't do that badly. Did Adobe obviously do badly on this day? Yeah, they were down a lot more than the market. Well, I put in one of, not necessarily a competitor, but in kind of Autodesk. I don't know if you know Autodesk, but they do this software package real similar to Adobe, but just in a different field. They were down as well, but if they'd been down 14, 15%, you would say there's an industry thing going on. But given Adobe's down 13 and Autodesk was only down 1.6, you can say the market was definitely reacting to their earnings release. All right. So you need those kind of comparisons. And that's why I gave you stocks. There was one stock I did. I was going to do Smuckers, and I found it's actually in here. You can see Smuckers is in here, but I hid it because it was just too boring. And it's not letting me unhide. I don't know why. Maybe I might have deleted it. I may have taken it. Oh no, Smuckers is J. I'm sorry. It starts with a J. Y'all probably thought Smuckers started with an S, but it starts with a J. So here's Smuckers, and you can look. Market reaction just wasn't all that strong. So I finally said that I'm not going to do Smuckers. This wasn't interesting enough. I want to give you some stocks you can really react to. So I left that one out. So you have everything you need as far as numbers go. You can probably create better charts. I wouldn't necessarily put these charts in there. You could if you wanted to put these charts in there. But I gave you these ones at the bottom so that you have some way to talk about it. So you can say Adobe was down 13.67% the day of the release, or the day after, the day that the market reacted to release. The market was down as well. The S&P was down as well, but only 0.64%. So the market reacted very, very negatively to this earnings report. Autodesk, also in their industry, was down, but not down nearly as much. And I gave you an index that this is the tech industry. It was down 1.29%. So you want all those numbers to see. Because if your stock's down 2%, but the market's down 5%, or your stock's up 3% and its competitors are up 7%, that gives you some context that maybe the report wasn't that strong. Target was a really interesting one. So Target beat dramatically, up 20 beat by 24%, and their earnings were up 57. How did the market react to that? Real positive, up 12%. Right? Costco reported very close to them. How did Costco do? Costco beat much higher. Anybody know how the market reacted? Down. How's that possible? It's interesting, isn't it? You as a finance major, okay, I gotta figure this out. Why would a good report for Target and they go up 12%, but a good report for Costco and they go down 7%? It means it's fascinating, right? If it's not fascinating, you're probably in the wrong major. Yeah, that's curious, right? And they reported pretty close to each other, 3.7 or 3.8 versus 3.4. So it's just a 3.5. So it's a few days. So if there's it's an overemphasis on this industry and everybody's excited about it, why everybody's so positive on Target? And maybe what happened was, and I didn't look back at this, maybe the Target report came out and Costco reacted really positively. And then 3 days later, Costco wasn't as strong as Target's, and so they came back down. Who knows? So you can look at a few days before if you want to. You can't do a few days after, because when are you really writing this report? The day it comes out, right? Probably within 10 minutes of it coming out. So I'm giving you, far more time than you would normally get in practice. So if you don't like all of these reports, find one other company and send it to me and I'll do this. It takes me about 5 minutes to add a new company. So if y'all add others, if y'all like some others, I'll just update this chart and say other companies and put them at the very end because it won't be alphabetical. And so if you see one you're really interested in, so Camille was talking about a firm in the insurance industry. She can send me that ticker. I can look at it. I'll have to change it a little bit because insurance companies don't have gross margin. So I might have to substitute something else for that. I do have a video that shows you how I got all this data. It's really, really powerful to do. Bloomberg has everything you need. They have the earnings calls, the transcripts. They also have something called Bloomberg Intelligence, which I highly recommend you check out. Bloomberg Intelligence has a long article about each of these companies and what's going on with them. So I think you just type BI. They may have changed it, but if you go into Bloomberg, you just look for it and you click on it. And if a firm has reported earnings, you'll probably find something there. Another place you can go is the UTSA library. Under databases. There's something called, and it's way down at the end, Investac, Intex, Merchant Online. So one thing you're supposed to be doing undergraduate is exploring all of these databases. So as an undergraduate student, you got to learn all the theories, but one of the things they're looking for in interviews is you got to know where is the data, how do I get my hands on the data, and then what do I do with the data once I get it. And you're spending a lot of money on these databases, aren't you? In your student fees. So here's a really, really good one to do. I like to go to, well, you can do, well, they've changed this up, but you can go look for your company. I forget how to do it. I haven't done it in a while. Let's try Target. You have to click around because it really is, it's not the most user-friendly database. But as long as you go through the UTSA library, you have access to this. So what the sell side does is they write analyst reports about companies. And if a firm has reported earnings, there's a good chance there will be a new analyst report 5 or 6, 7, 8 days after the earnings report. And that's a great source because you're talking about the most knowledgeable people of this company writing about what they just released. So you'd have to click, and there's a place to click. Company reports could probably be it. But plenty of stuff here. So you don't want to read something that was written before they released their earnings because that's just old news. But if you can find something like this, it works. Bloomberg has a similar thing. If you click on Bloomberg for your company, they'll have these type of sell side reports that you can click on. And if you click on it, you can email it to yourself. So you have plenty of resources for this type of information. So I won't show you a student example on this until after you've gotten started on it, so you kind of see what it's going. But I mean, this is the outline for the paper. You have a few paragraphs on earnings, a paragraph on revenue. On revenue, you're trying to find explanations on why revenue was higher or lower. Was there a particular product? Why was Target so much higher? What's going on with Target? That's a pretty impressive earnings report. Why did that happen? Why are people suddenly flocking to Target all of a sudden? And then right now, we're in the middle of this inflationary cycle. How's that impacting margins? Inflation tends to shrink margins. And then the rest of it's just commentary. All right. So questions on paper 2. It's I'm kind of jealous because I love writing paper 2. It's kind of one of my favorite papers.
Is all of this already available? It's on Canvas.
Yeah, it's all out there. So if you go on Canvas, you go out on Canvas, at the very, very bottom of Canvas, don't leave yet. We're not done. The very, very bottom of Canvas, yeah, paper descriptions and examples. So here's the paper 2 description, and there's the Excel files. So it's there. Questions on paper 2? All right, so I want to do, we got 8 minutes, so don't leave. I want to do one. We just talked about Target, so let's do Target. So I want to do target. And I want to do their January, February, and March returns. And the formula is ending market value minus beginning market value plus income divided by beginning market value. So let's do that. What is the big ending market value? Ending market values. What's the ending market value for January? So what are we looking for? January 31st. Ending market value 139.08. What's the beginning market value for January? Anybody remember that? What number are we looking for? That number or that number? 142.42. That's an easy number to remember. What's the beginning market value for February? Yeah, it's the ending market value. So February, I don't know if it's the 29th or not. Yeah, 29th, 159.92. What did I say? 50? 152 what? Right. Yeah, I can't remember things. 3 seconds. We don't have March yet, but we'll just use the latest we have for March. 170.46. You wouldn't actually do that. You would wait until the end of the month. And then the income. So we want X date. How do you know where X date is? There's a dividend on February 20th. Is that announcement date, X date, or payment date? Which date do we say we care about? X date. Which date do you think Yahoo Finance is showing you? X date. All right. So they paid $1.10 on February 20th. So which month's going to get $1.10? It's going to be February. All right. Everybody see that? And so we're going to do our return. We're going to do ending market value minus beginning market value plus income divided by beginning market value. There's the returns. They're doing pretty. How many of y'all had target in your portfolio? Doing pretty well. All right. If you leave the income out, it has a little bit of an impact, not massive, but it has a little bit of an impact. All right. So we'll do this a little bit more. What we got to do next class, though, is we have to link these together. One way we can link it is just to do the average. That's pretty straightforward. All right. And then we want to annualize that. So this is the arithmetic average. And then you can annualize. Annualizing arithmetic average is really simple. On average, they made 6.62% per month. How do you make that an annual number? You want to guess? Multiply by 12. Piece of cake. Well, we're also going to do the geometric average. And annualized. What is the geo average? What the geo average says is, what if I started with $1? What would I have at the end of the first month? You take $1 times 1 plus that. At the end of the first month, you have 98 cents. What would you have at the end of the second month? $1.08, right? You lost 2%, but you made 10. How much we have at the end of the next month? $1.21. What does the geometric average do? It takes that linked and raises it by 1 divided by how many months do we have? No, how many months do we have here? 3 minus 1. And what do you notice about the geometric average versus the arithmetic average? It's lower. What percentage of the time is the geometric average lower than the arithmetic? 100% of the time. It's always equal or lower. How do we annualize this? Don't multiply by 12. Instead, You have 12 months, you raise that to 12. If we had 60 months, you would raise it to the 12 over 60. If 100 months, what if we were doing weekly, what would we do? 52 over 3 or 52 over 100, all right? The annualized GEO can be higher than the annualized arithmetic, but the monthly GEO must be lower than the monthly arithmetic. And I'll show you why next class, why that's the case, all right? So we're gonna practice this a little bit more. You will have a question exactly like this on the exam, so we need to practice it. So, and you will have a team question on this as well. All right, we'll stop it there.